Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for the week ending Friday, July 5th, 2019. I hope everybody here in the States had a great Independence Day, and I'm back from vacation now. I took an 8-day trip to Costa Rica, had a great time with the family down there, and back ready to get into the charts here. All right, so we'll start out. For those of you, for members of the site, this is just basically a recap for the video I did earlier today on the broad, at least the portion on the broad markets. Of course, we covered the commodities and some other things in that video, and trade ideas as well. But I just wanted to do a quick recap here, and I'll start out with the monthly charts as I did in that other video. And because I wasn't here on the last day, I was out of the country on the 28th. So what I was watching for is we had those bearish engulfing candlesticks on the indexes that closed on the month of May and the end of May there, and I was watching to see if they would stay intact. In other words, would the markets close down below the top of those candles, which it did. So this so far we're popped a little bit above there. Now the month is very young right now. This most recent candle is July's candle, so none of that matters till what happens till the end of the month. I just want to mention June we did close down below there on SPY, QQQ as well. You can see June's candle. The body of that candle is down below the body of the previous one. So that's what I'm watching, and of course that's just a potential topping stick. We need to see this trend line on QQQ get taken out. We need to see that 20 period monthly exponential monthly average right there. Monthly exponential average, I should say, done a great job of defining the bull market. So those are the things we'll be watching for again on a monthly basis. So no need to update this chart very often, because again, a lot can and will happen before the end of the month, before this July candle is printed. So those are some of the things we're watching. As we drill down to the weekly charts, and what I said before I left town is that nothing could possibly change while I was gone that would alter my longer term outlook on the markets. Doesn't matter how much we would have rallied. We had a small rally since I was gone, but nothing that will change the longer term technical posture of the chart. So that all remains as it was before. You had the divergent high leading up to the big fourth quarter drop / bear market in QQQ. We fell over 20%, and that was foreshadowed by the negative divergences, and those divergences have only expanded on this slight marginal new high here in QQQ. So same story on SPY. They remain very much, the divergence is very much intact right now. However, we do need to see, to keep the case alive for a reversal, because as I often say, divergences in themselves, just like overbought or oversold readings, they're not buy and sell signals. They're merely an indication that a trend change is likely. You need to get then the sell signals that follow via trendline break, support break, bearish reversal candlestick patterns, things like that. So right now, looking at the weekly, you can see we had a bearish PPO cross recently, and then the lines whipped back together. So we had a false little whipsaw signal there that confirmed the divergences at that high, that previous high right there, right where my cursor is there. But they're still very much intact. So what we'd need to see to help to firm up or keep the bearish case alive and intact is to see a bearish crossover, PPO cross back down, turn down, keep these divergences intact. Because remember, they can continue to expand, and the bigger they get, it just means one of two things: either larger correction you would expect from the larger divergences, or maybe they get burned through. Still, I highly don't favor that. Nothing's changed in the technical posture. Again, the risk reward is very unattractive. And remember, if I sound like a broken record here, it's because the market has gone absolutely nowhere now for a year and a half. I could have been in a coma last year and a half. It's been a lot of ups and downs, a lot of trading opportunities, swing trading. But when you look, here's the Dow, for example. This is almost a year and a half. This is back in January of 2018. I'm going to measure there from where we hit a high of in January for the first correction there. And we're up 0.95%, so less than 1% in the Dow, and that's almost a year and a half there, where the market's gone pretty much nowhere. And you step back on that weekly chart, just looks to me like a very large topping pattern. You can call it what you want. Maybe it's a consolidation pattern like this was back here in 2015, 2016. Then the market broke out, anything is possible, but we all we know is that we're now in or near, depend on which time frame you want to look at, the longest economic expansion of bull market in history. So, the chance that we're going to go up, break out of this consolidation range as more of a continuation pattern and continue to go up. Is it possible? Sure. Is it probable? No, absolutely not. So that's what we're looking at. And again, it's a lot of the technicals and some of the things we're seeing in the fundamentals now rolling over. So let's go down and look at the SPY on the daily chart. It's up a little bit more than the Dow. Those are the two most common indexes quoted for the stock market, and so you have about a 3.5% gain in that roughly 1.5 year period there in the SPY. And then when we look at the daily chart, same story. So here's what I'm focused on now. We have just like we had leading up to the highs back in the fourth quarter of last year. We had that top there. We had the negative divergences, which were clearly marked below on the indicators. And again, they built up to this point. We had a divergent high. We continued to push up, diverge. We extended the divergences, and then boom, they played out. And this time around, as you can see, we had at this top right here, which was roughly an equal top in the SPY, we did have divergence on only the PPO there, not the RSI down below, almost flatline divergence. Now we have some clear steepening, if you will, of the divergences with these indicators making lower highs. So what's happened since I was gone, this week with the markets closed yesterday, is an abbreviated trading week, number one, and it's also very low volume. You can see the push that we had over the last week or so occurred. I don't have my volume bars turned up there. You can do this on your own chart. Very, very low volume, which is a sign of non-confirmation as the SPY has, eked out a marginal new high. And again, it's done so just as it did back here with divergence in place. And as I often say, there are no guarantees, but much more often than not, when you have a security or an index breakout to new highs with clear negative divergences in place, also while overbought, that sharply increases the odds that that breakout will fail. So this one took a few weeks, maybe a month or more for that breakout, because at this point, so you took out the previous high, and ultimately it failed, and it failed with a vengeance. That was a big drop there, and so again, I expect nothing less of that. You just have to be patient. Again, it's been, like I said, a year and a half, and the market's still where it was back then. And of course, we've had some big rips and dips within there. Now let's get down to the 60-minute charts. This is where I'm turning my focus again. SPY, what I've added here, again, since I left, we had the divergent high back here with pretty decent correction. You can see, I'll draw the blue lines here. We had this rising wedge pattern. Halfway through, you had that little bull flag continuation pattern, popped up, set up within this wedge, broke down here, and we had a correction. And that correction pretty much met the measured target for the wedge. If you take a rising wedge pattern, like I'm doing here, again, I'm going to highlight that same one, take the widest part of the wedge and add that to where the wedge breaks down. That gives you, that's the, what I find to be, it's the simplest, yet a very effective measuring tool to try to project where a pattern would go. Now, I thought there was the potential, and back then, that we could do more. Sometimes, you have a wedge breakdown, and it's the catalyst, at least here on a 60-minute chart, it's the catalyst for the longer-term bearish technicals that I've covered on the weekly and monthly charts to play out. So, we could have seen that continue. But with that being said, I just want to point out, you can see roughly, I'm doing a rough measurement. There's the widest part of the wedge, measured target, and then we had another thrust up. So like I often say, one of two things could have happened. We could have thrusted up, taken out the divergences, and that would be pretty bullish. However, we didn't do that. All we did is extend the divergences. You can see at this point, divergent high 1, correction, divergent high 2. It's the same divergences that we're building leading up to that earlier high. And that's a lot like, the market did back on the daily charts and, some of the other time frames. It's not uncommon to see 2, even 3 consecutive divergent highs before the big correction sets in. So right now, that's what I'm looking at. The divergence, but as I said before, divergences are not a sell signal. bullish or bullish divergences aren't a buy signal, and bearish divergences or negative divergences like this are not a sell signal. What would be a sell signal? Well, break of this trend line. It's pretty well defined in SPY. I'm going to get to the futures in a second. It's more interesting because we were back testing. We broke down comparable trend lines in the futures, and we're back tested today. So that's what you want to watch for SPY. I could probably add, and I should add, another level for you here. Again, since I was out of town or out of the country, very, very limited internet access, and when I had it, it was so slow. It was like AOL dial-up, but that's it. So here's some support. There's a gap right there, about 294. So. And then some other levels, and let's look at QQQ. We'll get to the futures and we'll wrap this up. So here's QQQ, similar wedge which broke down. This was while I was away. We had a breakdown here. It was impulsive. It started out a little slow, got impulsive, and then we pushed up. So again, it was roughly the measured target. You take the wide part of the wedge there, add it down, that's roughly the measured target. We pushed on up, and just like SPY I was covering a minute ago, simply extended the divergence, put in a second divergent high, or extended the existing divergences that were in place. And so now, trend line wise, I can't draw as good a trend line as I can on SPY that I just showed you, but this is decent. So you have a trend line off the lows, you have a reaction here, another reaction today, close enough. So these are the levels you want to watch. This would be a sell signal, a break, and ideally an impulsive break down below. Impulsive meaning, big red candle or multiple 60-minute candles, increased volume, things like that. And then you can see some of the nearby support levels, and those are all potential targets. And I think, down here. And you can also notice that QQQ is pretty much at that same level that it failed at back last, was it May, late April, early May, right here. We had several attempts at that 191-ish level, and then failed. That set up, nice divergent low, bullish divergence. We had the rally, and we're back there again. So you have a couple things going on. You have the QQQ at resistance. You have the negative divergences. And we're just, like I said, waiting for a sell signal on that. NQ, no, that's not gas. This is NQ here. As I said earlier, we have some comparable trend lines on the futures. At least the way I have it drawn here, I have it coming off these candles there. You can come in and get the low right here. The trend line would be a little bit different, but this is how this, I think, is the best fit right here. So you can see, just like QQQ, we had the divergence at that first point right here, and there was that minor trend line, broke down, and that set us up in this larger wedge, or this more significant longer term trend line here on the 60-minute chart. And when you zoom in a little tighter, you can see, as I mentioned earlier, we broke down today, and we did so pretty impulsively too. Not super impulsive, but somewhat. You can see a reversal here. You can see a little bear flag set up right there, and then the bear flag pattern broke down. That was impulsive selling, helped confirm or validate the breakdown of this trend line, the fact that it was impulsive. Kicked back, tested it. Again, when I was doing the video intraday for members, we're right here, and I said, that would be an objective shorting op there with a stop somewhat above the recent highs, and so far we reversed. So this will be continued over the weekend. Futures will start trading Sunday night, and we'll see where this goes. But that's a breakdown and a back test right there on NQ on the 60-minute chart. But like I said, all the better if you can see those trend lines on SPY and QQQ breakdown as well. Just puts the odds in your favor, especially because of near-term trend right now. The short-term trend is bullish. And let me find ES, and we'll wrap it up there. And same story on the ES 60-minute chart. ES are the S&P 500 E-mini futures. And so you can see you had the minor trend line, bearish rising wedge that broke down again recently, and then we set up here to pick up on that longer, more significant trend line off the lows as well. So that's the one I'm focusing on now. Let's clean up those lines. Show you again. It comes right off the lows here in what is that? Early June, right there, I believe. And pretty clean. You can see a lot of reactions here on the ES futures. There's another reaction there, breakdown, back test, and so they parked it at the close, pretty much right on the back test of the ES rising wedge pattern. So there's your divergences. You can see them down here, the divergence lines drawn, and like I said, to be continued next week. If we gap up, if the futures rally up on Sunday night and into Monday morning, that will mean these were false breakdowns, and that would open the door to pop to another new high. Otherwise, we head on down, and you can see there's a pretty decent support level here around 29.55. So, if you're bearish, then you can look. That'd be a quick early target for the futures. But I think if this breakdown sticks into next week, into Sunday night, Monday, I can tell you right now, this would be my preferred swing target here. We'll call it a target zone, about 29.17 down to about 29.02. And so whether you're bullish or bearish, if you're bullish, then you can use these levels that I'm looking at as both targets and or levels if they're popped, taken out, then that opens a door for additional selling, maybe more impulsive selling, especially if those levels are taken out. But if you're bullish, these are levels you can either add to on a pullback, you buy the dip, or if you're long, just trying to ride the current trend up, these I think are objective stop levels that you could have on a long. Set your stops just below those levels. So if you're glass half full, that's how you want to trade. If you're glass half empty, like I am right now, then that's what you want to look at. Go home short over the weekend, or see how things pick up Sunday night. I had said I just got back in town, and today's Friday on a low volume week, so I'm not gonna. I have what I have, the positions that I currently have, and I'll just not do anything until I see what happens next week, how the markets open up there. But that's the direction I'm leaning, and we'll pick it up from there. So either these these nice wedge patterns will be foiled next week, or they'll play out. So we'll pick it up there. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.